What is going on, investors? Back again. We're going to take a look at Under Armour, ticker symbol UA. They also have the ticker symbol UAA. This is by request. I did a video on this a while back, and I've had a lot of people ask me to cover it again. I waited till earnings this morning, and as you can see, the stock actually initially ticked up on earnings release, but as we can see here, I'm recording this intraday, and the stock is performing very poorly now as investors are digesting the numbers. We'll jump into the numbers here in a minute, and we'll take a look. I think it's really interesting and really fascinating what's going on at Under Armour. You're definitely going to want to take a look at these numbers. And then we'll also take a look at the stock chart. Look, this stock has been beaten down, as you can see here. Maybe there's some levels here where we can buy the stock. Now, what's interesting about Under Armour, they still got this $4.5 billion market cap. We'll take a look at that in relation to sales and revenues and things like that here in a minute. But what has also been going on with Under Armour is a terrible, terrible news cycle. Aside from the health situation that we've got going on and their stores being closed and sales falling off a cliff for almost all apparel makers, Under Armour's had some really, really bad news come across the tape here. Back in July, the stock was down 4% after the SEC doled out a Wells notice, which is not something that you want to have happen. Executive Chairman and CEO at the time, Kevin Plank, and the CFO, David Bregman, are the recipients of this Wells notice. Now, back in 2015 and 16, the company very shady, pulled forward some revenues to keep a 20% sales growth growing. So Kevin Plank would get on conference calls and brag about how they grew sales 20% for 15 consecutive quarters. And that was about to run out. And so the CFO and Kevin Plank devised a plan to pull forward some revenues in a way that's not technically legal from an accounting purposes. So these guys are, I believe, this is my opinion, I believe are 110% guilty. They're not going to go to jail or anything like that. My guess is they're going to face some kind of fine and disciplinary action, but it is not a good look for investors. The other thing you want to keep in mind is Kevin Plank is no longer the CEO, but he is the executive chairman, and he has complete voting control of Under Armour. So they divided the stock up into these two ticker symbols, and Kevin Plank owns the majority of the stake where he has the majority of voting rights. So while Kevin Plank is not the CEO anymore of the company, he has complete control. And he's done some, I would say, shady things in the past to get Under Armour to grow, and so I don't particularly trust him, but that's my own opinion. Under Armour might sell its digital fitness app. They paid over $1 billion for these fitness apps. I know it says right here the company bought the app for $475 million, but they're not including the other app that they bought and the money that they invested in it. So this has been a complete disaster for Under Armour, but divesting from it might be a good decision, but they're not going to get anywhere near this $475 million. I think they just floated this out here to find potential buyers. Sometimes companies do that. They say, hey, I'm looking to sell this. They tell some news outlet and it kind of floats it out there, but they're not going to get anywhere near $475 million for an app. Pretty much no one is doing that unless it's like a world-renowned app. Now, even more interesting, Under Armour terminates or is trying to terminate their $280 million apparel deal with UCLA. At the time, I remember I wrote an article about this on this very website, Seeking Alpha, saying this was a terrible deal, and people were like, oh, what are you talking about? Well, what ends up happening is Under Armour realized UCLA is not really that popular outside of the alumni and outside of the circle it is in LA. It's not even like, I would say it's not even like the third or fourth most popular team in Los Angeles, okay? You have lots of teams and sports in Los Angeles. To pay $280 million for an apparel deal with a college that's not particularly popular outside of its own little bubble is not a good idea. Now, Under Armour, these sponsorships deals with these colleges are what I just said. They're sponsorships. They're not meant to make money. What the negative impact about this is Under Armour is going to look bad anytime it tries to negotiate with any other athlete, with any other university, any other league. They also backed out of their Major League Baseball deal. They backed out of a deal with Cal Berkeley. Under Armour is pulling back on a lot of deals it made, and in my opinion, that's going to hurt it going forward, dealing with athletes, leagues, and colleges going forward. Now, they might be just changing their strategy, but it's a strategy that has worked for Nike, for Adidas, and several other companies, and so Under Armour is going the different direction, and it is going to hurt their brand and their negotiations with these other leagues and athletes going forward. That's my opinion as well. So let's jump into the numbers. Let's see what's going on here. Why are they having to cut cost? Why are the stocks going down so quickly at Under Armour? Well, we can take a look here. We've got net revenues here. Here's our 3 months ended here. Here's our 6 month ended here. In 19, we made $1.2 billion, and that slid all the way down to $700 million. That is not good. For a 6 month view, we went from $2.3 billion all the way down to, call it, $1.7 billion. Again, that is an absolute disaster, but understandable because, because of the situation going on. They've got stores closed. People are pulling back on their discretionary spending for the most part. Now, the interesting thing here is gross profit. How have they held up their gross profits? Gross profits we see here were 46.5% in the previous period, 49% here. So actually a little bit better from a gross profit perspective. And we see here over at 6 months ended, we went from, call it $1.1 billion down to $780 million for the 6 months in terms of gross profit. So it slid off a little bit, maybe not as bad. I think initially investors looked at this and it wasn't as bad as what people thought, but it's still pretty bad. Now, selling, general, and administrative expenses, how well has Under Armour controlled these costs? In my opinion, they haven't been doing a very good job. So we went from 47% of revenues here, and now it's jumped up to 67% of revenues. So these costs right now, they used to be 47% of revenues. Now in the quarter, it's 67%. That's not good. They're going to have to lay some people off. They're going to have to cut contracts, exactly what they're doing. So Under Armour is doing the right thing, in my opinion, but I believe also it's going to hurt the brand and hurt the company going forward in the long run. So in the short run, I think they're doing the right thing. Cutting cost is the right thing to do, but it's a difficult thing to do when you factor in the future of the company as well. So on the 6 month view, same thing is happening. We've had the selling and general administrative costs barely go down. It was like 1.075. Now it's 1.032. So they've barely cut any cost off of the company. And so that leads to this income or loss from operations here. For the 6 month, we were sitting at $727 million. For just the most recent quarter, we're sitting at $170 million. That's a complete and utter disaster. In the previous period, it was an $11 million loss. And we see here for the 6 month ended, we were actually at a profit of about $23 million. Coming down to the net income line here, we got $182 million worth of losses in the most recent quarter. Wow, that's a lot of losses. And take a look at the 6 month ended. 772, almost $1 billion of losses just in 6 months. That is not good, considering this company was making a profit of about $5.1 million in the previous period. So look, we've got almost, let's just annualize this out and call this $1.5 billion worth of losses for a year. Let's see how well capitalized Under Armour is. Before we get to that, the other thing that you want to see here is how much apparel sales, footwear sales, and accessory sales have fallen off a cliff at Under Armour. Take a look at apparel, down 42%. Footwear, down 34%. Accessories, down 47%. Licensing revenue, this is like the UCLA deal, down 75%. Everything. Connected Fitness, the app they're trying to sell, is the only thing that ticked up a little bit at 3%, but it's a relatively small amount of money for the company. So for the 6 month, let's just stretch it out for 6 months. That includes some months where things weren't on shutdown. It's still an absolute disaster. Everything's down about 30%. Some things down even more than that. This is why this brand is in big trouble, because how many brands fall off a cliff like this and then all of a sudden are resurrected and cool again? I just don't see a lot of examples of it. You actually see a lot of examples of the opposite, like Reebok and Fila, and you can just go on and on. There's lots of apparel companies in this space that were once cool, and then once the brand lost its momentum, it is very hard to get it back, especially if you're not going to spend it on marketing and endorsements and things like that. Now, net revenues by segment: North America, Europe, Asia Pacific, Latin America, connected fitness, everything has fallen off a cliff. Obviously our segment revenues are falling off. And so obviously by geographic region, it is absolute disaster. Now, everything's basically losing money except for North America right now. And this connected fitness is churning out a little profit. So I think they're going to be able to sell the connected fitness business. But if the operating income on it is $7 million and we can annualize this out to maybe $15 million, I don't know what premium they're going to be able to get on that in the marketplace. Maybe a 5x premium on that. So they'll get a little bit of money for it. They'll probably find a buyer for it. But I don't think it's going to be nearly what they paid for it. They're going to lose money on that business. Now, how well capitalized is Under Armour? We've got our current assets here. We've seen if the trend continues, this is a company that's going to lose well in excess of $1 billion over the next 6 months. So cash and cash equivalents are right at $1 billion. So that's not good. Obviously, we've seen it tick up here. We know this is not from operations, so they are having to leverage the balance sheet. And obviously by cost cutting as well, probably going to help things out. Now, inventories have not held up either very well. So we've got, just from the beginning of the year, we had about $900 million, and that has ticked up to $1.2 billion. That is going to pressure margins in the future. They're going to have to dump this inventory off to the TJ Maxx's and the Marshalls of the world, or their outlet centers, or whatever it is. So this is going to affect higher price goods as well, because I can just go and find an Under Armour t-shirt on clearance rather than paying $35 for a full price one. So things are not looking good, in my opinion, here. Total assets are sitting at $5 billion. Come down here to liabilities. We see our long-term debt here that did tick up. We were in the previous period here, we were at 500, call it 600 million. It was about the same at the beginning of the year, and then it has gone up. That's close to 50% jump here as well. They've also got this revolving credit facility, almost like a credit card. They are drawing from that as well to the tune of $250 million. In my opinion, this is a company where the longer things don't improve here, where stores can be open, people can get quote unquote back to normal, this is a company that's going to have to do more fundraising because this is not looking good to me. We see the proceeds from the long-term debt credit facility here went up to 1.2, call it $1.3 billion in the quarter. This is not good. In my opinion, this is a company that has just over $1 billion. They've got this account receivable here, which has gone down a little bit. We'll give them credit for having about $1.5 billion worth of cash or cash coming into the company. And this is a company that lost $700 million over the last 6 months. And if the next 6 months look anything like the past, then this is a company that is not very well capitalized going forward. Let's jump into the stock chart. We see here the stock was actually in a really good spot up here. And then, boom, we had this huge gap down here, and it just kept falling. Now, the stock has kind of, seesawed here over the last few months, as a lot of stocks have, especially in the apparel business. So it's just seesawing, trying to figure out what's going to happen. We see it comes up here to this $10 range. And actually, what's interesting, here's today's action. The stock, for the very first time, kind of peaked up over this. And I think what some algorithmic trading saw was once this stock broke this, call it $10.55 level, well, there's not a lot holding it back from going to 11 and even higher than that. This stock, if it breaks trend and starts trending up, this stock could easily, in my opinion, get all the way back up into $15 range. So there is a little bit of excitement there, and I think that's what we saw initially with this stock today when it peaked up on earnings. Actually, technically, it looked really strong for a minute, and plus we're in this short-term uptrend, and so this stock could have easily got to 11, but I think as investors started digesting the numbers and started looking at them, boom, we see this candlestick dropped all the way back here. So in my opinion, this stock is probably headed back to the bottom of its range, barring any kind of positive catalyst, which I don't necessarily see for the apparel industry. I think this stock is probably headed back down to the call it 850, 830 range. And that, to me, if you're confident that there's a turnaround story in Under Armour going to play out, that would be the first level where I would look to buy shares. I wouldn't buy shares anywhere in the middle of this range because it's just going to want to come back here. Now, if it breaks this $830 range, it's going to come all the way down here, in my opinion, all the way down to the 660, 650 level as well. This, to me, would be where I would be a little more excited about Under Armour. Now you're getting it at a bargain basement price. It's possible the company could have a bidder buy the whole company. Maybe Kevin Plank wants to just walk away altogether. Again, it's going to be Kevin Plank's decision whether or not the company decides to sell itself because he has full control over the company. It's possible down at this point you get a bidder that bids it back up into this level. Now, that's all negative. The longer this stock churns around in these ranges, in my opinion, the harder for it is going to be to break trend and get back up here. The faster this stock can kind of break this trend and get back up in here, there is a ton, I'm telling you, a ton of blue sky over this stock. Once it breaks through this $10 level and closes above it, actually $10.50 is what I would call it. If it closes above $10.50 a share, you're probably off to the races, in my opinion, all the way up to 11 and even higher than that. I mean, we're probably talking easily up into the $12 range, and it wouldn't surprise me after a couple weeks this stock could get all the way back up to 15. Now, it's going to take a lot of positive developments. You're talking with the health situation and with Under Armour in particular, you're going to have a lot of positive developments for that to happen. But there is some good news, I believe, on the horizon for this company, but it might get worse before it gets better. Personally, I would avoid this one altogether unless it hit this bottom of the barrel price, because this is a company that's probably going to have to be fundraising. They're going to have to be cost cutting. I do not want to buy companies in today's environment that are cost cutting and fundraising. I'd much rather buy the Amazons and the Apples and the Netflix and the Googles and the Facebooks of the world that are reinvesting in their business, that are churning profits, that are taking more market share from people that are falling by the wayside. So that's my opinion on Under Armour. I think we're going to chop around in a range here. I wouldn't touch it unless it's at one of these levels, but you got to really believe in the story. And personally, it's just not there for me yet. So there's Under Armour for you. We'll be back again later today and this weekend with more videos on the stock market. Lots of exciting things happening. Thank you for everybody for growing my channel over 10,000 subscribers. Thought that was going to take a lot longer than it did, so I want to thank everybody for that. We'll be back again very soon. Good luck with your investments.